Did you know that you can engineer a simple portfolio of blue chip stocks that not only delivers monthly dividend income, but one that has also driven returns on par and in some cases even better than the S&P 500? All of that with lower volatility and risk. That's exactly the type of monthly income portfolio we're building today in this video. And no, we're not chasing gimmicky high yield funds that promise the world, but crack the moment you pop the hood. We're constructing a real monthly dividend portfolio. When you combine these bellwether stocks the right way, you create a smooth passive income stream that dishes out monthly payments like clockwork, all while your long term returns quietly compound in the background. A quick break here before we dive into all of the details. A lot of the visuals you're actually going to see in this video are from Dividend Watch. It's the all in one solution that we've built for dividend investors. You can automate tracking your income, find new top stock ideas, and much, much more. Of course, it's free to sign up, but if you see what you like, there's a coupon code in the description for 20% off pro annual plans. Just use code YouTube at checkout, and you'll also get a 7-day free trial. So many investors assume you need monthly dividend ETFs to get monthly income, but you really don't. The majority of high quality dividend stocks pay quarterly, but the challenge becomes picking the right ones so you can build your own income portfolio without chasing yield or taking on unnecessary risk. The key is choosing reliable blue chips that keep you diversified across sectors with payout schedules that naturally stagger throughout the year. Put together correctly, a portfolio of quarterly payers can function exactly like a monthly dividend machine. But before revealing the right stocks to buy to build this portfolio, it's important to understand why monthly dividend portfolios are so popular with investors in the first place. In short, monthly income is both psychologically and mathematically powerful. Mathematically speaking, more frequent dividends means more compounding opportunities, perfect for dividend growth investors growing their wealth through reinvestment strategies. Psychologically, monthly cash flow feels more like real passive income, helping investors stay consistent, which is one of the primary reasons why most hobby investors overwhelmingly underperform the market. And lastly, for income focused investors covering expenses with dividends, a monthly dividend portfolio smooths out budgeting and eliminates the stress of waiting for quarterly payouts. Okay, let's get into the details of this portfolio looking inside Dividend Watch. And you can see on the screen here, we've got a rundown of all the holdings from Apple on down to Pepsi, S&P Global, Cisco, AT&T, Target, Walmart, all bellwether names that you're familiar with. And I'm going to throw up a screenshot as well. This is from a recent post we had on Instagram where it includes all of these specific stocks and their payout month to see how this portfolio is constructed. And importantly, how we built out this portfolio is to give a 5-year time horizon. So we've got transactions based on the 5-year ago price. And it's also assuming that $10,000 is invested in each of these stocks. And you can see that reflected here with 24 holdings. And of course, $10,000, that'd be about a $240,000 basis. So importantly, there's two statistics that really stick out. First off, looking at the dividend yield, it's a respectable 2.4%. Now, that's not something like you get in a very high yield portfolio, but it's also not something you would get in a very high growth portfolio where dividends aren't paid out frequently. So it's actually a pretty respectable yield, of course, for these names as well. But importantly, this is one of the key statistics to pay attention to, the zero point 0.8 beta volatility. Now, what this means is when the market is down, this portfolio is going to be down less than the market. So it's more resilient in market downturns or market crashes. And critically, a lot of that comes from the portfolio diversification. You'll see in the diversification view that there's a heavy allocation to consumer defensive stocks, about 28% in this specific instance. And of course, there's also some other defensive names in there in the healthcare industry from AbbVie to Novo Nordisk, Johnson & Johnson, and Merck as well. Now, the nice thing is you also get some exposure to other cyclical and high growth industries as well. Consumer cyclical at 13%. Technology has a pretty good representation at 12% within this specific portfolio. Now, with such a diversified portfolio, it's not surprising that you're also going to have diversification across the months. And this really gets at the point of why this portfolio is built. You can see inside the dividends view within the product that every month there are consistent payouts from 2021, 2022, 2023, on up to present, and of course going forward as well. And These payouts range anywhere from, $696, low of about 610 on up to $900 plus based on this specific portfolio allocation. And when you tally it all up, that's around $8,400 in annual income. Again, the 2.4% portfolio yield we talked about, and impressively, a 3.5% yield on cost and about 2.5% dividend growth rate. Now, that's to be expected with stable bellwethers like you've got 2 to 5% dividend growth rate over a long time frame is very consistent with some of the biggest names out there. And here's where it gets really interesting as well. When we look at the total performance of this portfolio, we're seeing some pretty good return numbers. Over this 5-year time frame, there's about a 7.3% average annual rate of return, total return essentially of this portfolio. It's good, like I mentioned, but it's not shooting the lights out, especially when you consider over the last 30 years, the average annual return of the S&P 500 is right around 9%. But this portfolio, as it currently stands, we're essentially looking at a Ferrari that's driving in the slow lane. And I'm going to show you what I mean by that. And we'll jump into this holding with Apple. So within Dividend Watch, we've got a feature where you can turn on dividend reinvestment. And let's speed run through it, and we'll go ahead and turn on dividend reinvestment for all the securities within the account. And you can see in the before and after here, what we've got is the portfolio with dividend reinvestment turned on for all securities, and then the original scenario with no dividend reinvestment. And in the dividend reinvestment scenario, the portfolio return increases to around 10.2%. Now that's over the past 5 years. But again, when you look at the overall average annual return of the S&P 500, it's 9% for the past 30 years. We've been able to, over this time frame, outperform using just a monthly income portfolio invested in bellwether stocks. And you can see the proof in the pudding here. Just turn on dividend reinvestment, and that's where that snowball effect comes into play. And you see the much higher overall average annual returns. Now that we've walked through how this whole system works, the mechanics, the structure, the strategy, all of it, the real question becomes, is this approach the right one for you? In essence, there are two types of investors who fit that bill. One being long-term dividend growth investors who reinvest consistently and want compounding to work over time. Number two would be investors who need steady, predictable monthly cash flow to cover real-life expenses. But of course, this setup isn't for everyone. If you're a retiree focused on capital preservation with a lower risk tolerance, this ain't it. Stocks are fantastic, of course, long term, but they can be a roller coaster in the short term. And planting seeds you plan to harvest tomorrow is rarely a good idea. Money you'll need in the next 5 to 10 years, that belongs in safety, not in stocks. Monthly dividends can be incredibly powerful, but only if you've got the time horizon and the patience to let the strategy work. So as we've seen in this video, a monthly cash flow portfolio is something you engineer, not something you guess at. By combining quality, diversification, and smart scheduling, you can smooth out income across the entire year. You remove the frustration of waiting for quarterly payments, and if you reinvest those monthly checks, you accelerate the compounding process that turns a simple dividend strategy into a real wealth building snowball. If you enjoyed this breakdown and want to build your own portfolio like this, check out Dividend Watch in the description below. It's free to sign up for an account. Then if you like what you see and want to get serious about dividend investing, you can sign up for a pro annual plan and get 20% off. So with that in mind, let's build wealth, collect checks, and stay patient. I'll see you in the next one.